Of the hundreds of dividend stocks out there with a history of raising their dividend for at least the past 5 consecutive years, there are only 3 of them currently, just 3, that have a dividend yield north of 10%. These 3 dividend stocks are, number 1, Arbor Realty Trust, ticker symbol ABR. Number 2, NextEra Energy Partners, ticker symbol NEP. And then third, Aris Commercial Real Estate Corporation, ticker symbol ACRE. But just because they're a sweet dividend yield right now does not mean they are a safe dividend yield right now. Which of these 3 are a dividend trap, if any? What are the key metrics you need to look at and be aware of to make an informed decision? We're diving into all 3 of these right now. What's up, you guys? Welcome back to the Average Joe Investor channel. We're looking at the January 2024 dividend stock spreadsheet. And for your awareness, as always, if you want access to this spreadsheet and all the future monthly dividend stock spreadsheets, access to all of the other spreadsheets I use on the channel, access to my portfolio, the changes I make to my portfolio and my income strategies, and most importantly of all, I think, access to the Discord community of hundreds of other Average Joe investors, check out the link down in the description below. Okay, so like I mentioned here, the top 3 and the only 3 dividend stocks with a current yield north of 10% are ABR, NEP, and ACRE. First off, let's take a look at Arbor Realty Trust, ticker symbol ABR. ABR is a mortgage real estate investment trust, meaning they are in the business of lending money. We'll dive into that more in just a second. They currently have an 11-year dividend streak of raising their dividend. Current price as of January 14th was $14.71, which is right in between their 52-week low and their 52-week high. Their revenue growth numbers are really strong, 12.75% over the previous year, 26% average growth for the past 3 years, and 15% on average for the past 5 years. The 1, 3, 5, and 10-year dividend growth rates are amazing. 9%, 11%, 11%, and 13%. All those numbers are great. Their current dividend yield is 11.7%, which is slightly elevated compared to their historical 5-year dividend yield of 10.56%, so effectively a 20% discount. One thing that's interesting with ABR is they recently transitioned over to weekly options frequencies. So if you're interested in reinvesting those dividends and actually selling covered calls on this stock, you can do so now at a weekly basis, which makes it, I think, a lot more profitable. Now let's take a look here at the dividend safety. Now, this metric here is based off of free cash flow, but free cash flow is not the best way to measure mortgage real estate investment trusts. The best method is to look at net interest income because they lend money. The method I like to look at is the dividends paid divided by net interest income. Now, to get this information, we need to go to the financial statements. My preferred method is to go to Morningstar's website. Once you go to ABR, you click on financials right here, and we come down to the financial statements. First, we need to go to cash flow to get the dividend paid. Oftentimes, if you're worried about a dividend, I like to first look at the annual numbers and then look at the most recent quarter or two or the trailing 12 months at a bare minimum to see if there's any change or difference between those and the annual numbers. We're going to scroll down here for financials all the way down to dividends paid right here. Common stock dividends for the trailing 12 months is $369.52. So I'm going to make a quick note here on a piece of paper, $369.52. Now what we're going to do is we're going to go over to the income statement, which is where we're going to get our net interest income. I'm going to scroll down here and go to right here, net interest income. We can see for the trailing 12 months, $437.47. Making a quick note here, $437.47. So let's grab our calculator. Now it's clear from these two numbers that there is more net interest income than dividends, and that's a great sign. But let's figure out our specific ratio here. So we'll take 369.52, which was the annual dividends paid over the trailing 12 months. Divide that by our net interest income, 437.47, equals a ratio of 84%. This is reasonable and normal. As long as net interest income is moving up somewhat to the rate of the dividend, I'm not concerned about Arbor Realty Trust. One thing I also like to do here is go to Seeking Alpha just to see what the articles are being written about in the news and analysis. Not that I put all my stock in it, but just to see what a lot of the analysts are saying here. I take this in conjunction with some of the other metrics that I look at. You can see here that there's not a lot of concern about the dividend being cut, though there has been concern in the past about the short attacks and disingenuous articles being written about Arbor Realty Trust. In my mind, though, as long as Arbor Realty Trust is continuing to make money and has that net interest income that's increasing in line with the dividend, I'm not concerned. I think that Arbor Realty Trust dividend is safe. Now, we'll see what actually happens, but based on everything I can look at, it looks okay. Okay, next up, let's take a look at NextEra Energy Partners, ticker symbol NEP. They're in the utility sector of the economy, and they have a 9-year streak of consecutively raising their dividend every single year. Their price as of January 14th was $28.88 per share, which is very close to their 52-week low and much, much lower than their 52-week high. You can see revenue is still pretty strong, not as strong as the 3-year growth rate. We had 9% here over year, 12% over the average over the past 3 years, and then 9% over the previous 5 years on average. While the dividend growth rate here over the past 1, 3, and 5 years is really strong, they have signaled, which was one of the biggest reasons why they had a massive price drop in the past 5 or 6 months, was that this growth rate is not sustainable. They plan on being somewhere between the 6 to 10% range. Now, as a result, their stock price has taken a huge hit, which is why their yield is so high, especially when you factor in their yield against their average 5-year dividend yield of only 5%, currently 12%. Now, NextEra also has weekly options frequency for those that want to actually write covered calls. Let's take a look here at the payout ratio based on free cash flow. Now, the reality is with any utilities company and some energy companies, free cash flow is not a good measure of dividend safety because these types of companies in these sectors of the economy are mandated or required essentially to reinvest a significant amount of cash flow back into the structures of their business. This could be maintenance of buildings, maintenance of oil pipelines, etc. So these numbers, you can see though they were pretty strong in 2019, 2020, and 2021, much lower in 22 and 23. I took a deep dive into NextEra Energy's annual reporting, as well as some of their news releases on some of the big impacts and events that have occurred recently. The big deal here, this is where they reiterate in their earnings release, where they talk about how they expect 6 to 8% annual growth. A review of their transition here. Essentially, what the big problem with NextEra Energy is they've got a bunch of debt that's coming due here in the next 12 to 24 months, and they have to replace that debt. And now is not a great time to replace debt, because interest rates are higher now than they were 5 to 7 years ago when they probably took that debt out. And as a result, their costs are going to go up. One of the things they've done here is, and it shows right here that they haven't done it yet, but they just recently announced it. They did sell their Texas pipeline portfolio. Here's the link right here, which did open up quite a bit of cash, which will allow them to offset some of that debt that they have. Additionally, they recently announced in December a new offering of debt that they're trying to use to replace some of their debt here. These are due in 2029. And if you scroll down here a little bit further, it indicates that the net proceeds from these sales are expected to use in their general funds to repay their 4.25% senior notes due in July of 2024. And they have more due in September of 2024 right here. How this changeover of debt and the loss of some of the income from their Texas oil pipeline, how that's going to impact future growth, hard to say at that point. They seem positive, but then again, we expect every company to be positive about their outlook. Given everything going on with NextEra Energy, I think this would be one that you might want to hold a little bit on, especially since their yield is so different here from what it has been historically. As we can see right here, 12% versus 5%. So, I mean, it could be something you could sprinkle in your portfolio a little bit, but I wouldn't classify this as a safe dividend, given the fact that their free cash flow has had such a dramatic shift over the past 5 years. Lastly here, let's look at Ares Commercial Real Estate Corporation, ACRE, another real estate investment trust here. They've got an 8-year streak of raising their dividend, though I think that this number is in jeopardy now of going away, and I'll explain that in just a second. Current price is $10.15 per share compared to their, well, just right in between their 52-week low and 52-week high. This is the part that really gives me pause, right? You've got a 46% drop in revenue over the previous year, 10% drop over the past 3 years, and then 4% over the past 5 years on average. This growth rate here, I'm not sure this is 100% accurate. I'll have to double check this. I'm not sure why this is reflecting that is still on this list, and I'll show you why. The current dividend yield is 13%, which is great, and it's not that much higher than their average yield in the past 5 years of 11.65%. You can see here that the payout ratio based on free cash flow is north of 100% over the trailing 12 months and over the previous year. And you can see that their free cash flow per share has stayed pretty stagnant or gone down compared to what we've seen in the past. The majority of analysts think that there's going to be a dividend cut. Doesn't mean that there is going to be one, just means that that is some piece of information we should take into account based on all of the other metrics we're looking at as well. Let's take a look at the payout ratio based off of net interest income like we did with Arbor Realty. Let's first off take a look at our dividend. So we'll go ahead and go up to the cash flow, and we'll scroll down here again and find our dividends paid way down here. Cash dividends paid, 77.07. Okay, then we'll go back up to find our net interest income here, which is 104.97. So 77.07 divided by 104.97, which is at 73%. This is actually lower than Arbor Realty Trust, though these numbers have fluctuated quite a bit over the previous years. You can see there was a large jump in net interest income from 2021 to 2022. When you factor in the revenue drop here and the fact that their payout ratio is really high based on free cash flow, and given all the analyst opinions out there, this one of all the three I would classify as probably the least safe of them. It also has the shortest dividend streak here among all of them. Not that that matters in and of itself, but it's one factor to consider as well. By the way, I did take a look at the actual dividends paid for Eris Commercial Real Estate, and I did see here it looks like they were raising their dividend year over year, but then I show that they did have a dividend drop in 2023. So I don't think that this is going to be considered on the spreadsheet moving forward here. I looked at every single amount paid, and it did technically drop and not increase in 2023. So from that perspective, you could say that their dividend streak is over. If I were actively buying dividend stocks right now, and I was looking for high yield, the only one I would actively buy would be Arbor Realty Trust ABR right here. This is not a recommendation, by the way. I have no idea what the future holds. All three of these could cut their dividend. All three of them could maintain their dividend and grow it. Hopefully you found some value out of this video, guys. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. That's all I got for you. Have a great rest of your day, and thanks for watching.